Hey, Archie, what does history tell us about what we should expect from the market during an election year?
Well, Rob, let's check the numbers. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast. We're your hosts, certified financial planner professionals Archie Hoxton and Rob Hoxton, brought to you by Hoxton Planning and Management. We've got some exciting news today. We are broadcasting from our new studio here at the Hoxton Planning and Management headquarters. You may notice some minor changes, but if you were to turn the camera around, you would see it's a much larger room. And, hopefully when we bring a guest on or two, we'll have a little bit more room to accommodate them. So,
Yep. And our wonderful production folks got a new piece of equipment that is designed to remove the extra double chin. So I have lost that for this episode. Thank you.
Yeah. Thanks to them. That's always good. So, yeah. So today we're going to talk about a very interesting and kind of one of those get your blood going topics.
Yeah, lately this is we're getting a lot of this question.
Yeah. And it's politics and the effects of politics on the capital markets. And so it's very charged, and there's a strong belief among many people that politics are a primary driver of what happens in the markets. I would say that is kind of a myth, and we'll do a little bit of busting of that. But
I totally get why people might think that. I mean, and it's interesting because we work with people that have views across the spectrum, from very conservative to very liberal, and a lot of people in the middle.
Yeah.
And what we find is that the people with the strongest feelings in whatever direction are the ones that are most worried about the market if their candidate doesn't win.
Right. Or if some bill is passed, or things like that.
Right.
Yeah.
Right.
Yeah, and we get a lot of those questions. So typically what we do is we look at the data and what's happened in the past.
We like data.
Yeah. I mean, it tells a story. And when it comes to politics, the effect is a lot less than people make it out to be. One of the interesting things about the markets, and we'll dive into this a little bit later, is how much human emotion plays a role in what happens in the markets on a short-term basis. The fear and greed cycle, people get afraid and they sell stuff off, they get greedy and they want to buy in. And that does move the needle a little bit, but it's not the fundamental drivers of what goes on in the markets.
It's so true, Archie. Whenever anything big happens in the news, like over a weekend, I'll sit there, watch the news, and I'll think, I wonder what's going to happen in the markets tomorrow. And when I was a younger man, there were times when I thought I knew what was going to happen in the market. Mm-hmm. And as I've done this longer and longer, now 32 years, actually 32 years, July 2nd, I've realized that it is completely unpredictable.
Yeah.
I mean, I think back to the 2016 election when Donald Trump kind of surprised the press at least, and won. I remember I was looking at watching the returns. I couldn't sleep, and I enjoy watching that regardless of what year the election is. So I tend to stay up late and watch those returns. And I noticed I was watching the returns. I was looking at my phone at CNBC and watching the market. And at like 3 o'clock in the morning, the Dow futures were down over 900 points, which at that point, a 900 point then was much bigger deal than a 900 point move now, with the Dow over 40,000. So I assumed the market is going to take a beating tomorrow, or later this morning, as the case was. And it did open negative at 9:30, but by 10:04, it was trading positive. So it's just impossible to predict. But the good news is you don't really have to predict it.
Right. You don't. And that's the thing. If you're investing for the long term with long-term objectives in mind and tuning out the noise, You don't need to predict it. You can rely on what's happened in the past and the fundamental reality of businesses making more money and becoming more profitable into the future. That's what we ultimately want to see, and that's the primary driver of growth in the capital markets. But I think it would be helpful to look at what presidential election years look like going back into history.
Yeah.
And so, it's easy to think, well, this time it's different. Well, there have been a lot of elections that it was like, this time it's different. And there's a lot of turmoil, and there does tend to be a little bit of volatility around the election. Like you said, Dow futures were volatile at 3 a.m, before the results were announced. So there can be volatility depending on people's expectations. But really, election years tend to be good years in the market. Like, on the whole, most often, they're just another good year in the market.
There are very few exceptions to that, and there are usually extenuating circumstances, right?
Right.
We have this is a great find, by the way. Archie found this terrific one-pager that was put out by an organization called First Trust out of Chicago. And this is not a pitch for them, but it's just a great piece, and it shows every election year going back to 1928.
Yeah.
Right? Yep. And when you look at it, there's a reason more than just the election why there were negative returns in the handful of years where there were negative returns.
Right. And also, if you look at another point that is interesting, is you look at, blue or red, there's no impact, right? They're both very, very positive. On the whole, on average, when a Republican is elected, the average return is a little higher, but really it's positive returns under both parties. So it's not, and again, there are so many other factors. So, and that may be affected by the fact that, if we look at 2008 was a very, very hectic year in the economy. It was the credit crisis. It was one of the worst recessions ever. Really, the Great Depression is the only market event that I would say at magnitude
modern history
would outweigh it. But negative 37% that year. So it'd be easy to say, well, it was a Democrat was elected. But it's like, well, no, it was one of the worst economic events in modern history. And of course, that was the primary driver of the market returns that year, not the fact that it was an election year.
Yeah, I mean, if we go back and we look, you had an election year in 1940, Roosevelt. For that 12-month period, the S&P 500 was down 9.8%.
Yeah.
What else was happening in 1940?
It was
World War II. Yeah. If we go, so then the next negative year, an election year, you had to go
all the way
to 2000, when Bush, the younger Bush W, was elected, and was down 9%, but that was the year that the tech bubble burst.
Right. That was the dot-com bubble. That was another one of the great bear markets in modern history. I mean, it was so, but you look at almost all of the others, and of course, there's another Roosevelt year that was negative, but 1932, what was going on there? We were in the heat of the Great Depression.
Yeah.
The following year,
and that was only minus
8%. Yeah. So you look at this, and you're like, they're mostly good. And if you take election years, going back I have this written down here. This is a piece from Vanguard. Again, we're not pitching it, but they put out some interesting research. In 41 election years, the average return of those election years was 8.7%. Out of 122 non-presidential election years, the average was 7.7%. So a whole percentage point difference. So it's like, presidential years are good years for the markets oftentimes, unless there's some other major political event or economic event going on at the same time.
A question that so we get these questions a lot, especially in these years, and naturally we would get them, of course, like, should we be doing something different with our portfolio given the fact that we're in this election year? And by golly, this election year seems crazier than most of them.
Yeah.
Right? So, yeah, I mean, as we're recording this, last weekend there was a assassination attempt on former president, and it just seems like, wow, these seem like crazy times. The question I'm getting, though, oftentimes has been, okay, well, if Trump wins, what's the market going to do? Or if Biden wins, what's the market going to do? Well, this is the first time, probably, maybe it's happened before. I'd have to check my presidential history. But we know what has happened after each one of these guys has been elected president.
Yeah.
And it hadn't been too bad, frankly.
Yeah. In both cases, we've had multiple really good years in the market in succession of one another. And we've had unusual economic and global circumstances, particularly the economic circumstances that came out of COVID and the fallout economically from that. And we've still had good results in the markets under both.
Right.
So that's a really good point.
So with this in mind, with the idea in mind that the markets are going to do what they're going to do, but they're probably going to be fairly favorable in an election year.
Yeah.
What's the advice for clients? It's the same advice that it always is, isn't it?
Yeah. It's really simple. Have a well-constructed, diversified portfolio. Aim for the long-term goals and don't give in to the short-term temptations of fear or greed, and stick with the plan.
Yeah, and address those short-term concerns, those short-term financial needs, and the odd thing that might just pop up that costs you money. Address that with different money.
Yeah.
That's not investment money. That is your short-term emergency fund.
Yeah.
Your operations fund, one of those buckets. Sometimes you hear financial planners talk about a 3-account system, one where you've got savings, you've got emergency, plus your operating checking account. Have those accounts funded correctly. Be in a position so that if there is a pullback in the markets, you can weather that storm, but maintain for your investments a long-term view.
Absolutely. Yeah. I mean, the other thing about this is that there's always a temptation to make a big change or to bet on something. And I think when people think about betting on something in the markets, they think about taking more risk. But sometimes you have to remember, you can bet the other way. You can bet on taking less risk. And the bet is that I think something is going to happen that's going to affect the markets negatively. So I'm going to gamble on that and take a lot less risk. Right?
And that's an expensive bet too.
Yeah, because here's the thing. You really need all of the best days in the market over the course of your life, of your investing horizon, in order to be successful. If you look at June 30th of 2003 to June 30th of 2023, if you were invested the whole way through, you averaged 10%, we're talking about the S&P 500, you would have averaged 10% a year. If you missed the 10 best days out of like over 7,000, well, that would be calendar days, but thousands of trading days, if you missed the 10 best,
only 10,
your return is nearly cut in half.
Wow.
If you missed the 50 best, you actually would have had a negative return for that period. So that sticking with it and riding through and being patient, having the short-term money.
Thank you for reminding me of that. I've known that before and I've forgotten it. That is just an amazing statistic.
Yeah.
If you missed the 10 days out of the last 10 years,
20 years,
your return was cut in half. If you've missed the 50 best days out of the last 20 years, you had a negative return.
You might as well have been sitting in cash and not investing to begin with. So if you think that there is a chance that you could miss those 50 best days, and there definitely is, if you're betting on your fear and greed cycle,
maybe
probably
you
shouldn't invest at all. I mean, yeah, absolutely. So, yeah, I mean, I think that's the key when we have turmoil and there's, a lot of talk of what's going to happen in the markets and terrible outcomes versus good outcomes. I think it's really important to tune out some of that noise. And
if you're
stick
worried
to your
about
plan.
if you're worried about it, talk to your advisor. You're paying that advisor to help you make smart decisions. And oftentimes those decisions are the ones that don't always feel good.
Yeah.
Feel is a terrible word when it comes to investing.
Yeah.
So talk to your advisor. If your advisor isn't available to talk to you, talk to us.
Yeah. We have the number here on the screen. If you have those questions, if you like the content and you want to learn more, you can give us a call or a text, leave us a comment, and really importantly, subscribe, like the video, hit the bell for notifications so that you get notified when new videos and content comes out. And anyway, we hope you enjoyed it, and we look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.